Something unusual is happening in the silver market right now, and the strange part is that almost nobody outside a small circle of traders seems to be paying attention. While financial television debates interest rates and stock market volatility, something quieter and potentially far more significant is unfolding behind the scenes. Inside the vault networks, the warehouse systems, and the delivery mechanisms that support the global metals trade, subtle changes are starting to appear. These changes aren't dramatic enough to make headlines yet, but they are exactly the type of signals experienced commodity traders have learned to watch closely, because markets rarely move in sudden explosions without first sending quiet warnings to the people who understand how the system really works. If you look only at the price chart, silver might appear to be doing what it always does. Prices rise, prices fall, and analysts argue about what comes next. But the real story of commodities rarely begins on the surface of the chart. It begins deeper inside the infrastructure of the market itself. The warehouses, the contracts, the inventories, the movements of physical metal across continents. That hidden machinery is where the earliest signs of stress usually appear long before the broader financial world realizes anything unusual is happening. Right now, silver is trading at levels that would have seemed almost unimaginable only a few years ago. Investors who ignored the metal during long periods of stagnation are suddenly rediscovering it. Financial commentators are starting to discuss it again. But price alone never tells the entire story. The real question is what the underlying system is doing beneath that price. And when traders begin asking that question, the first place they usually look is the delivery network tied to the futures market. At the center of that system sits one of the most important metals exchanges in the world, the COMEX. This exchange operates as part of the larger framework of the Chicago Mercantile Exchange Group, and it plays a central role in setting benchmark prices for precious metals across the global financial system. Every day, enormous volumes of silver contracts move through this market. Most of those contracts are never settled with physical metal. Traders buy and sell them for speculation, hedging, or portfolio management. But the system is still built on the idea that physical delivery is possible. That physical foundation is what gives the futures market credibility. Inside the warehouse network connected to that exchange, silver is not simply stacked in a single pile waiting for someone to claim it. Every bar is carefully cataloged and classified. Some of it is labeled registered metal. That classification means the silver is officially available for delivery against futures contracts. The rest sits in the eligible category. Eligible silver is still stored inside approved vaults, but it belongs to private holders who have not committed it for delivery. To a casual observer, those categories might seem like technical details. To someone who understands the mechanics of the futures market, that distinction is critical. Because when traders begin demanding physical settlement of contracts, only the registered portion of the inventory can immediately be used to satisfy those deliveries. Eligible metal might eventually be converted into registered metal, but that requires the cooperation of the private owners who control it. And those owners may have very different motivations depending on what they believe the future of the market looks like. For years, the structure of the silver market has been stable enough that most investors never worried about those details. The inventories fluctuated but remained within comfortable ranges. Industrial demand rose gradually. Investment demand came and went in cycles. Nothing appeared structurally dangerous. But in the past few years, the balance between supply, demand, and stored inventory has started shifting in subtle ways that are drawing the attention of analysts who follow these numbers closely. Part of the reason silver has become more interesting is that it occupies a unique position among commodities. Unlike gold, which is primarily held for financial purposes, silver sits at the intersection of finance and industry. It is both a precious metal and an industrial material. That dual identity makes it unusually sensitive to changes in technology, manufacturing, and global economic trends. When industrial demand expands rapidly while investment demand also increases, the pressure on supply can build quickly. One of the most powerful drivers of that demand in recent years has been the global transition toward renewable energy. Solar panels require silver because of its extraordinary electrical conductivity. Each panel contains small amounts of the metal, but when you multiply that requirement across millions of installations, the numbers become enormous. Governments around the world are investing heavily in solar infrastructure as part of broader energy transition strategies. Every new solar farm quietly adds another layer of demand for silver. Electric vehicles are creating a similar effect. Modern EV systems contain complex electronic components, sensors, and power management systems. Silver plays a role in many of those components because it conducts electricity more efficiently than almost any other metal. As global automakers push aggressively toward electrification, the cumulative demand for silver inside those vehicles continues to expand. Then there is the semiconductor industry, which relies on silver in certain specialized manufacturing processes. Medical technology uses silver for its antimicrobial properties. Telecommunications equipment, including components used in advanced data networks, often requires it as well. When you combine all these sectors together, the industrial side of the silver market begins to look less like a niche commodity and more like a strategic material embedded deeply inside modern technology. At the same time, investment demand for silver has been quietly returning. During periods of economic uncertainty, investors often rediscover precious metals as a store of value. Inflation concerns, the currency fluctuations, and geopolitical tensions can all push capital toward assets that are perceived as tangible and historically resilient. While gold usually receives the most attention during these cycles, silver often follows closely behind because it offers similar characteristics at a lower entry price for many investors. Exchange-traded funds have become one of the primary gateways for this investment demand. Vehicles like the iShares Silver Trust allow investors to gain exposure to silver through the stock market without handling physical metal directly. Under normal conditions, these funds track the value of the silver they hold quite closely. But during periods of intense buying pressure, their market prices can drift above the underlying net asset value of the metal they represent. When that happens, it signals that investors are eager enough to secure exposure that they are willing to pay a premium for convenience and liquidity. Another investment vehicle that has drawn attention from serious metals investors is the Sprott Physical Silver Trust. Unlike some other funds, this trust emphasizes allocated physical metal stored in secure custody at the Royal Canadian Mint. For investors who worry about the distinction between paper exposure and physical ownership, that structure carries a certain appeal. When markets become uncertain, questions about custody and deliverability begin to matter more. Meanwhile, mining companies provide yet another layer of signals about how the market might be evolving. Firms like First Majestic Silver and Wheaton Precious Metals tend to react strongly when investors anticipate higher metal prices. Mining equities often behave like leverage bets on the underlying commodity. When silver moves upward, the potential profitability of miners can expand dramatically, and their share prices sometimes rise faster than the metal itself. Recently, several of these companies have experienced bursts of investor interest that suggest equity markets are beginning to position themselves for a stronger silver cycle. Large financial institutions also play an important role in the physical silver ecosystem. Banks such as JP Morgan Chase operate vaults, facilitate trading, and participate in the logistics that move metal through the global supply chain. Their activities often remain largely invisible to the general public, but shifts in institutional positioning can influence the entire structure of the market. All of these pieces, industrial demand, investment flows, warehouse inventories, institutional activity, interact in complex ways that shape the future of the silver market. None of them alone guarantees a dramatic outcome. Commodities are influenced by countless variables, and predictions are always uncertain. But when multiple signals begin appearing simultaneously, experienced traders start watching much more closely. Because the most important shifts in markets rarely begin with dramatic announcements. They begin quietly, deep inside the infrastructure that supports the system. They begin with small changes in inventory numbers, subtle movements of metal between vaults, unexpected premiums in investment vehicles, or sudden bursts of interest in mining equities. For now, those signals remain scattered, like pieces of a puzzle that has not fully revealed its final picture. But history has shown that when enough of those pieces start aligning, the market can move far faster than most observers expect. And by the time the broader financial world recognizes what is happening, the most significant part of the move may already be underway.